Hello and welcome to session 21 of our Series 7 exam overviews, brought to you by Passing Score, where you can find our mobile apps and other helpful information at passingscorefinance.com. This is the second of our three parts on options. In this video, we'll be going over calls, puts, and other positions, as well as the break-evens and gain-loss calculations for those positions. In the last video, we were looking at the short call position, which is selling the right to buy shares in a firm. We have a $500 premium which we receive, which our maximum gain represented by this straight line here. But as long as the stock continues to rise, we could lose money up to an unlimited amount. Our break-even point is $5 beyond the strike price. And we can see that here, the strike price plus the premium is equal to our break-even, which is the same for both sides of the position. Whether you're buying or selling the call position, you'll have the same break-even point. Now, this is a very visual way of looking at an option position, which makes our position very clear. Now let's look at the numbers behind this, which is another way of looking at an option position. We have our strike price of $44, a premium of $5 per share, which represents that $500 we received, since option contracts come in bundles of 100 shares. Our maximum loss is that solid line going downwards, which is unlimited as long as the stock rises. Our flat line on the left is at $500, and our break-even dollars is the strike price of $44 plus the premium to arrive at a $49 share break-even price. The next position we'll look at is the long put. This is when we're purchasing the right to sell a security. In other words, we have a bearish position. We're looking for the stock market price to decline. And again, we can see here we start off underwater because we've paid that premium right up front. And as long as we get beyond this break-even point, we'll make money. And we can see in just a moment how the calculations for this work very similar. We have the strike price instead of plus the premium. We have the gains going to the right. We have the gains going to the left. So we're going to minus the premium to figure our break even and our gains. And we can see the math here. We have our same $44 strike and $5 premium, but our maximum loss is the $500 premium that we paid, and our maximum gain is $3,900, which is a complete loss to the company. The market price goes down to zero, less the $5 a share that we paid to own the right of selling the shares, this put position. And our break even is $39 a share, which is our $44 minus the $5 for the premium. And we saw that here, our break even strike price minus the premium. And as the shares are going down, we're going to reach that break even point and make back our premium and hopefully a little more. Our next position is a short put. Now, this is the selling side of that long put, which we just saw. So the straight line is flipped over. We end up making money, or being in the black anyway, when the shares are going high, since the bet was that for the purchaser of the put that the shares would go down, and that's when they make money. And the flip side of that is the short put is going to lose money when the shares go down, up to a zero market price for the shares. And as we mentioned, this break-even point is the same for both sides, the buyer and the seller. The strike price minus the premium. And let's look at the numbers for this side of the position. We have our 44 and 5 dollars per share, which we saw earlier. And now we see that the loss and the gain calculations have reversed. Our maximum loss is $3,900. Our maximum gain is that flat line of $500. And our break even is still the same as the long put position at $39 a share. Our next position is called a covered call. In this case, we've bought the stock, but we've sold off the right for someone else to buy that stock at a preset strike price sometime in the future. And here's how the graph looks like. We have a flat line because we've given away the upside. That option, that call option, gets the benefit of those gains so that we just end up with a premium plus some small stock price gain for the amount the strike was above our purchase price. And we end up losing money when the stock price goes down, mainly because of the shares, but offset somewhat by the premium that we've received. So in this case, you're betting that the stock price doesn't move too much beyond its original point, certainly not too far above or below the strike price. And again, we see the break even is the strike price minus the call premium. So this is our visual graph of what's going on. And again, let's look at the numbers behind it. We have our same strike, 44, and call of $5. In this case, our maximum loss is if the stock goes down to zero. Now, if we had just bought the shares and the stock had down to zero, we would have lost $4,100. But since we sold a call option, we got $500 of that back, so that our total loss only ends up being $3,600. Now, the price of that offsetting on the downside is that we've given away our upside so that no matter how high the stock goes, our gain is capped at $800. Now, this is the strike price that we're going to get paid to sell off our shares, minus what we paid for it. So we get a $3 gain on the stock price increasing, plus the premium on the option for a total of that $8 per share. And again, we have that $39 a share break-even point as the shares decline. This is a protective put option. This is when you've bought the stock and you've bought the right to sell the shares at a given strike price. Now you'll notice that this graph, this straight line of the behavior of this position, this protective put, is the same as a call position. And that's exactly what it's doing. It's mimicking a call, or it's called a synthetic call or a protective put. But the pricing, the math, the gains and losses are exactly the same as a call position. And we can see that here. It's like you're paying a premium and you're getting unlimited gains on the upside. And our break even at $49 a share. Another position is called a protective call. In this case, we're borrowing and selling the shares, betting on a decline in the stock, which is shorting the stock, plus we're buying the right to buy back the shares at a strike price. And the result, the net result between these two positions, a short stock plus a long call, is a synthetic put, otherwise known as a protective call. And you'll notice again, this solid line is the same behavior as if you had just bought a put position. And the math for that, again, works out the same as a put position. We have a loss of $800, which is similar to the upfront premium, and then gains as the stock goes down to zero, offset by the premium of $3,600, the premium that we had to pay, which offsets that gain. And our break even is on as the shares decline. So we're gaining back the premium that we paid and then hopefully a bit more. But the gains don't start until $36 a share after we make back the premium. Our next position is called a covered put. Now, this is when we short the stock. Again, we're borrowing and selling the stock, and then we're also shorting the put. So we're selling the right for somebody to sell the shares back to you at a given price. And we can see the solid line here is the net of the two positions. Our break even is the short sell price plus the premium. And let's look at the math behind that. We have an unlimited loss as the stock rises, and we saw that here with this solid line heading downwards as the stock price would be going up. And then we're flatlined on the gain side to the $200. And again, that's the The straight line that we see here is at $200 net premium amount. And the break even is at $46 a share. Our next position is called a long straddle. It's when we buy a call and buy a put. So we're paying for a call and we're paying for a put, betting that the stock price will either move sharply up or sharply down to offset those premium payments. Now, this is different from other positions in that we have two break-even points. So a downwards and an upwards break-even point. And we can see that here, if the strike price plus or less the premium amount uh, is equal to one of those, we're at the break-even point. And we have an unlimited gain on the upside and a limited gain if the stock goes down to zero on the downside. And here's the math for that. We have the break even, which is 44 plus 8 and 44 minus 8. So we have our two break even points are at 36 and $52 a share. If the stock price doesn't move, if it remains kind of hanging around that strike price, we end up at our maximum loss of $800. But we have the potential for unlimited gains if it rises or a $3,600 maximum gain if there's a sharp decrease in the stock price. Now, the flip side of that position is called a short straddle. Now, this is the opposite. We want the stock price to stay just where it is. We don't want it to move away from that strike price. And the reason for that is that we've sold a call and we've sold a put. We've we've gathered up the premiums on a call and a put, and we want to keep those premiums. We don't want to give them away if there's some sharp rise or decline in the stock. Now, this has to be done with the same strike price and the same expiration date for the call and the put for this specific position. And we can see here our break evens are the strike price plus and less the premiums. And our maximum gain are those premiums. So we're planning, this position is just a play on keeping the premiums for a stable stock. And we can see that here our break evens are again 44 plus and minus $8. And we have some potential for losses if the stock price makes big moves either upwards or downwards. Now, there's many other types of combinations of calls and puts, but some general terminology is that you have a long combination if you're buying the call and a put. You have a short combination because you're short the positions if you're selling a call and a put. And this doesn't mean that the expiration dates or strike prices have to be the same. They can be any kind of combination that you want. Uh, they were the same for those specific positions, but you can create anything beyond those. Some other terminology is a call spread is when you buy and sell calls with different strikes or expiration dates. And a put is when you buy and sell puts with different strikes or expiration dates. Price or vertical spread is when you call or if we have a call or put spread with a different strike price, so the dollars are different, but the expiration dates, the time, they both settle at the same time. So that's called a price or a vertical spread. The price is what's variable between the two options positions. You can also have a time, horizontal, or calendar spread. Those all mean the same thing. In this case, you have different expirations. So our times are different. Our times, our calendar, our horizontal as we go along the timeline are different, but we have the same strike price. And then we have a diagonal spread, which is the prices, the strike prices, and the expiration dates, the times are both different. That's a diagonal spread. There's also what's called a net credit spread. This is when you buy and sell calls or puts so that you receive a net payment. So you sell an option position and make the premium, but you buy another option position for less than that, so that the net between the two is that you've made money. That doesn't mean you don't have risk. You can have very risky positions, but as far as the premiums are concerned, you have a net payment. And the other side of that is you can have a net debit spread. You can buy and sell calls in some combination, and the net of the premiums is that you end up paying a net premium amount. And that's it for our session 21 of our options section. There's one more video on options that'll complete our trilogy of options for the Series 7 exam. And if you have any questions, please feel free to email me at john@passingscorefinance.com. And as usual, good luck on your exam.